If you've owned your own home now for just a few years, you might be sitting on over $100,000 and not even know it. And the scary part, most people never tap into this, and they miss the real chance of building real wealth. Hi, my name is Aaron from Opiak Finance Solutions. My role is pretty simple. I help people unlock the hidden opportunities in their home. Most people think building wealth comes from working harder and longer, cutting back and saving, but sometimes the answer is already under your own roof. So let's dive into how equity actually works. Think of equity as the part of your home that you own. The bank owns part of it, but you also own a part of it too. As the property value goes up, the amount that you own goes up too. For example, the first time you bought a property for $700,000 and you owed the bank $400,000, the portion that you owned was $300,000. Fast forward a couple years and post-COVID, a lot of properties in Australia have gone up dramatically. Your property is now worth $1 million. And to keep the math simple, you've left the $400,000 ownership. That means your slice of the pie has grown to $600,000, which gives you a loan to value ratio or an LVR of 40%. But here's the catch that's often overlooked. Banks won't let you use all of that equity. There's a cap. Usually they cap it at around 80% LVR, which in this case equates to $800,000. Now subtract your $400,000 loan and you're left with $400,000 of usable equity. That's the slice you can actually put to work. So the big question is, when can you actually use that equity? Banks work this out using something called your loan to value ratio, also known as your LVR. I know it sounds complicated, but it's actually quite simple. It's just your percentage of the loan compared to the property's value. Most banks are comfortable lending up to about 80% without charging you lender's mortgage insurance. So let's take that $1 million property as an example. 80% of $1 million is $800,000. Your current loan is $400,000, and that leaves $400,000 of usable equity. But here's the catch most people don't realize. Just because you have the equity doesn't mean the bank's going to let you access it. The banks also check you can actually afford the repayments with what they call serviceability. They will have a look at your income, expenses, and all other debts before they approve anything. So the real key is you need both equity and the ability to service before you can actually unlock it. Now, one of the biggest traps I see people fall into when they try and access their own equity is something called cross-collateralisation. It sounds technical, but what it means is the bank has tied the two properties together under the one loan. So they have a lot more control over your property. So why is that a problem? Let's say you wanted to sell one of your properties or refinance down the track. Because they're tied together, you can't just sell one property. The bank might force you to revalue or restructure the loan across all of them. This takes away your flexibility and gives the bank far more control than you realize. A much safer approach is to keep each property separate so each property can stand on its own. This way, you stay in control of your property portfolio and not the lenders. Now, having said that, it doesn't mean that cross-collateralisation is always a bad idea. This is just another tool in our tool belt, and it does come with risks. You just need to be prepared and have a clear exit strategy for this to work for you. It can sometimes help you move forward a bit faster. The key is making sure you know what you're getting into and having the right plan in place before you commit. So once you build up all this equity, the big question is, what can you do with it? The smartest way to think about equity is not that it's free money, it's a tool. Used well, it can help you move forward much faster. When used poorly, it can really set you back. Here are a few smart strategies I have seen work very well. Number one, buying an investment property. This is the most common way that we see it. You come to us and we refinance your current property, pull out the equity so that you have a deposit for your second property, and so on. That way, you're not waiting years just to save the money in cash. Number two is funding renovations that add value. If you use equity to improve your current property, like renovating the kitchen, adding a bedroom, or adding a granny flat, often increasing the property's value and the rental income at the same time. And number three is building a long-term property portfolio. Some people like to use equity to repeat the process over and over again. You take equity from property one to buy property two, and then you take equity from property two to buy property three, and so on. Done safely, this is how everyday Australians build real wealth over time. Now, here is an important point. Whenever you are using equity, be sure to keep some funds aside in an offset or a reader account. This might actually help you sleep well at night. Life happens, and having a safety net is what keeps this strategy from becoming stressful. And finally, not all use of equity is smart. Things like buying cars, boats, or taking expensive holidays, they might feel really good in the short term, but they don't help you grow your wealth. In fact, they can sometimes put you in a far worse position. The key to using equity is to find things that appreciate in value or help you create wealth. You don't want to use your equity to buy things that go down in value. Another important point is tax. When you use your equity to invest in something, quite often the interest is tax deductible. But if you use it for personal spending, like buying a car or a boat or going on a holiday, it isn't. That's another reason why it pays to use equity wisely and you should definitely speak to your accountant about this. Okay, let's take a look at how some people have actually used their equity. In the first example, I have a client that works in the mines that called us up and wanted to know what he could actually do with his property. We found that his property had doubled in value, which is a big surprise, and he'd also been aggressively paying the home loan down. With that, we were able to release $298,000 of usable equity, which was originally planned for a new investment property. However, the plans changed. Something popped up in his family, and because he had the money sitting in his offset account, he was actually able to pivot really quickly and help his family out with a different investment. Actually having access to that equity in his bank account gave him the speed and confidence to actually get the deal done. Another client found that they had about $500,000 in usable equity, and they wanted to build a duplex. We helped them refinance and release enough equity for the deposit and a small buffer. This particular client's goal is to build a large portfolio over time. This client's goal is to build a portfolio with our guidance and our team of professionals. So once the funds were ready, we passed them on to a colleague that specializes in duplex projects to get them started on the next step. And the third example is a client that decided to go on a different path. They did have some equity available, but they decided to save instead, putting aside $400 a week until they could reach the $300,000 needed for their deposit. At that rate, it would take approximately 15 years to save the required deposit. Now, by that time, the property market's definitely going to be in a very different place, and the opportunity they thought they had will have been long gone. This really shows how getting into the market sooner allows more time for compounding growth to actually work in your favor. Now, here's something really important to understand. Just because you have equity doesn't mean the bank will allow you to use it. Lenders look at two things. The first is your equity position, which we've already covered, and the second is your borrowing capacity. Borrowing capacity is all about whether you can actually afford the loan. The bank will look at your income, your expenses, how many kids you have, and a bunch more factors. The bank also adds a buffer on top of the current interest rate to make sure that if the rates do go up, you can still afford the loan. So here's the key point. Having equity is only half the story. You also need to be able to service the loan for the bank to approve anything. This is where working with a broker can make a really big difference, because we understand how to present your situation to the right lender at the right time. So once you've unlocked your equity and maybe bought your first investment property, what comes next? The smart approach is to think of equity as a tool that you can reuse to grow your wealth over time. Here's how it often works. You buy your first property, that goes up in value, and the loan is paid down. That creates new equity, and you can use some of that equity to buy another property. And as that one grows, you repeat the process again and again. Done safely, this is how everyday Australians build real wealth. It's not about buying 10 properties in 1 year. It's about a steady, repeatable system that compounds over time. The key is safety. Always keep a buffer in an offset account for those unexpected expenses or things that come in. That buffer is what allows you to sleep well at night while your portfolio does all the heavy lifting. You can think of it like climbing a ladder. Each property is like another rung on the ladder, but you always want to make sure that the ladder is stable before you take another step. So just to quickly recap, equity is the part of your house that you actually own, and you can usually access up to 80% of the property's value. But remember, the bank will still check your ability to service the loan. The smartest uses are things that build wealth, like investment properties or renovations or portfolio growth, and not things that lose value. And the earlier you act, the more time compounding growth has to work in your favor. If you are wondering how much equity you actually have in your own home, we are offering an obligation-free equity assessment where we can run the numbers for you and see exactly what options you have available at zero cost to you. So all you need to do is get in touch. We can book a time to go through this together. And I'd love to hear from you. Is there anything in property or finance you'd actually like to know more about? Leave them in the comments below. Thank you so much for watching. Hopefully this has given you a clearer picture of what equity is and what you can actually do with it. Thank you, Aaron from Opiak Finance Solutions.